Good morning and good afternoon for some of us. Welcome to Beyond Compliance. My name is Aaron Bolshaw with Safety Chain Software, and I'm the moderator of Beyond Compliance. For those that may not be familiar, Beyond Compliance is a periodic industry update for process manufacturers. Our goal is to bring you insights around the market that shape the way we grow our businesses, deliver quality products to customers, mitigate supply chain risks, safeguard brands, all while improving yields, maximizing productivity, and of course ROI. So today we're really putting the beyond and beyond compliance around a very important topic in finance that continues, I think, to challenge almost any organization. We're going to get into solving standard costing problems with lean accounting. And so really excited today to kind of dive into this. So just a bit about Safety Chain. We're the #1 plant management platform trusted by over 1,500 manufacturing facilities to improve yield, maximize productivity, and ensure compliance. And we are scheduled for about an hour today. We have a lot of great information to cover with some compelling stories. So we're going to stay flexible with that time because we do want to get to some questions. We can't hear you, but we want to hear from you. So if you will, through the presentation, use the console on your right to send us some questions. We'll get to those at the end of today's presentation. And off the top, just to answer everyone's favorite question, if you do want to get the slides and the recording from today, all of that good stuff, just ask us. We'll make sure that we follow up with you. So with that, I do want to introduce our speakers today. We're very fortunate to have the co-authors of Practicing Lean Accounting, and they both lead the practices at BMA and Torrey Consulting. Nick Katko and Mike DeLuca, welcome.
Thanks, glad to be here.
Yes,
thank you.
So just want to give a little background to give you guys a bit of experience here. So Mike, your lean journey began with implementing lean accounting as a finance leader in the early 2000s by evolving finance department's role to meet the challenging and changing needs of lean organization. Now as a lean coach, you work with companies to adopt lean thinking in accounting and finance, strategic planning and deployment, value stream, which is nice, and also cross-functional improvement. Very fortunate to have you. Thanks for being here with us.
Thank you.
And Nick, you've been practicing lean accounting for 30 years, both as a CFO, boots on the ground, and as a lean accounting trainer and coach. And then your practice, BMA, you leverage your experience in lean accounting and really that philosophy of lean accounting to assist clients in developing, leading, and coaching them in their lean accounting transformations, which is definitely a big lift. You've also worked with companies around the world, from family-owned businesses to multinational companies in industries such as manufacturing, healthcare, software, engineering, and service. And then before sitting down and penning practicing lean accounting with Mike, you were also the author of the Lean CFO in 2013. So you guys bring a lot of heavy lifting with you to Beyond Compliance. We're happy to have you here. And Nick and Mike also, just for the audience, work collaboratively through BMA to provide lean accounting and training, coaching, and consulting. We're going to make sure if you have any questions, you have their information here on the screen. We're going to show that again a little bit later as well. So lots of great resources from both of these gentlemen, and I appreciate you being here. So,
all right, go ahead.
One thing I think we take a lot of time and resources in manufacturing to do is drive lean programs and processes. I mean, we talk about this all the time with our clients at Safety Chain, but I think there's this huge other component of a successful lean transformation of any organization. So Nick, why don't you take us through the agenda for today, and then we're going to start off with a poll in just a second as well.
Okay, thanks a lot. So we have a pretty simple agenda here. What's wrong with standard costing in the context of a lean manufacturing company? And then we're going to explain. And we're going to give you lots of real life examples of issues that we have faced over the years in working with companies. Then we're going to give you a brief overview of how lean accounting solves those problems. And we'll wrap up with some practical advice, and then we'll do the questions and discussions. I did want to add one thing. I should have given it to you, Aaron, is that we do have experience in process manufacturing with lean accounting in terms of food industry, lumber, and paper. So those were, I just wanted to let some of the attendees know that. So, okay, let's do the polling question.
Yeah,
and then
so
we'll get
yeah, we like to do these. So Nick and Mike, we like to just kind of take the temperature of everyone on the phone with us. This will take just a second to launch. This is one of those really funny things that we use GoToWebinar for, and there's always this lag. But I'm going to launch this poll in front of everyone. You'll see in just a moment what best describes your current situation with standard costing, and we just want you to select one of them. We're not taking names, it's okay. We just want to, we won't show your names. We want you to be honest. Take a second. We understand problems, want to eliminate it. We're already in the process of eliminating standard costing, right? You know there's a problem, you're moving towards a fix. Maybe you want to eliminate it but don't have leadership buy-in. That often happens. You know, if you don't have a CFO that really gets it and understands it, you're going to have a big roadblock maybe. Don't plan to eliminate it because we don't see the need. Or finally, we don't currently use standard costing. So that's maybe you're in a different boat. I'll give you just about 10 more seconds to before we close the poll, but really just be honest. It just helps us to all understand who's quote unquote in the room, in this virtual room around us. So, and I'm going to close this now and share the results. And I'm just going to ask Nick and Mike to just comment on what we're seeing, who's with us.
Looks like a pretty normal distribution.
Yeah, we don't plan to eliminate it because we don't see the need. I think we might, so we have our work cut out for us, gentlemen. All right, well, Nick, I'm going to hand this back over to you then. I'll hide the results and we're going to get on with the presentation. And so I think we want to start out with just kind of, pinning the tail on the donkey. What's wrong with standard costing?
All right, so, what's the problem? Okay, and before I explain, this is a summary of like 4 major issues. I'm going to give you some examples of this. A brief verbal history of sort of standard costing, lean accounting. So, for those of you who might not be familiar with standard costing, it's probably been around about 100 years or so. The origins of it sort of are varied. Some people say it started with Henry Ford and the moving production line. It's pretty well established in a lot of manufacturing companies even today. And what's interesting about anywhere in the 25 to 40 year ago range, as lean thinking took hold in a lot of manufacturing companies, these problems sort of bubbled up to the surface. And people like Mark DeLugio, Brian Maskell, Jerry Solomon, Ori Fumi, Gene Cunningham, myself way back when in 30 years ago, all of us worked in lean companies and sort of individually realized that we have problems. For example, when you look at the profitability based on a standard cost, you're looking at an estimated cost because that's what it is. It's not an actual cost. And so, motivating non-lean behavior was really a big thing in lean companies because standard costing is designed for mass production manufacturing, and it actually works quite well. But if lean thinking in a manufacturing context is like the opposite operating behavior of mass production. So if you think about it, you have information designed for mass production, but you're trying to operate using lean practices. And so there's like this conflict that arises between what the information says and what lean thinking says. And what that leads to is poor decisions. We're going to show you some examples. And it's not just financial decisions, it's also operating decisions. And the last piece is a standard costing system consumes a great deal of time and effort of employees. Most standard costing systems are part of ERP systems. They're built in. So also there's a cost element involved because companies have invested lots of money in their ERP system, and standard costing is in that. Okay, so you have that integration there. You have the reporting of transactions, production reporting, which sort of forms the foundation for the numbers that are going to be used in a standard costing system. You have setting the rates and maintaining the rates. You have the time and effort of people to analyze all this information. And then there's what I would consider sort of the hidden waste, is that because a lot of the information, even in a non-lean company, understanding all the standard costing data, it can be very confusing to people. And then you put it in a lean company and the lean practices, you have even more questions and discussions about, what does this information mean? And a lot of that discussion you could consider a form of waste. So let's look at things in detail here. All right, so we have a typical income statement that is based on standard costing. And maybe some of you have been in this situation where if you look in the current month that the sales are greater than the previous month, but the margin is less and the profit is less. And then the question is, okay, how can we, sell more product and ship it, but our profits are less? And then, immediately you look at the margin and maybe the answer is, oh, well, it was the product mix. Okay. But then you get into all those variances. And without going into a lot of detail, these variances are very difficult to analyze because, first of all, our friend Jerry Solomon likes to say this, you have, what does the parenthesis mean? Does it mean it's good or it's bad? And are you subtracting the number from, is it more of a cost or less of a cost? First of all, that's just very confusing. And secondly, when you're looking at any variance, one issue is, could the standard be off? And maybe the actual is more accurate. I often say that, variance analysis, and the analogy is it's like a dog chasing its tail because, the dog never catches its tail and you never really get to understanding what's going on. So this is very, very confusing to understand, hey, how did we get where we are today and why is it not like last month? So, what do? You create what we call plain English income statements. Okay, and what we're doing here is we're going to look at margin or like operating margin on an actual cost basis. Okay, we want to eliminate standards. We just want to, actual revenue, actual costs. So in this case, you see in the current month, sales were greater than the previous month, and the actual margin was greater. What caused the decrease in profits? That was the inventory adjustment, the change in inventory. Okay. Now, without getting into a whole lot of detailed explanation, this is something that, accounting and finance has to do to properly state the financial statements. And the change in for financial reporting purposes, the change in inventory can have a positive or a negative impact on profits. So now we get a better view of what really happened. And we can look at the margin number and we can talk about it in about the operational impact, and then the financial impact is a little bit different because of inventory valuation. Standard costing also motivates non-lean behavior. Let's look at the purchase price variance, for example, which is a common performance measure that comes out of a standard costing system. So, you know, the only way that you really get a favorable purchase price variance is to buy a whole lot of inventory. All right, you know, any supplier is going to give you a price break if you say, hey, you know, give me a price, I need a lower price. They say, well, just buy a whole lot of stuff and I'll give you a break. That helps the supplier, but it doesn't help a lean operation. And so excessive buying to get a good price is sort of polar opposite of buying only what you need to produce what you need. If you look at overhead absorption, okay, and again, this is for those of you who are not in finance or may not understand this, this is the overhead. These are the expenses that get capitalized into inventory. So you reduce expenses and you put them on the balance sheet. So you can have, you can sort of manipulate the profits by overproducing, okay? And I've encountered that a lot, even personally as a CFO, where manufacturing knows they're not going to ship the products that they need to ship because maybe they can't get them out the door. So let's just produce a little inventory because we know we're still going to make a profit. And again, that's counter to the make to order environment of lean. If you look at production variances, you know, in general, the way that you have favorable production variances to have long production runs, large batch sizes, okay? And again, that's counter to quick changeover in order to meet the actual demand. And finally, if you're looking at product costs, you know, there's a tendency to try to manipulate an individual product cost to improve its margin, or maybe a family of products like that. And again, that's counter to maximizing the value stream margin. So the point is, if you're in a lean environment, and if you're using some or all of these performance measures as real indicators of how well operations is performing, you're creating a conflict, okay? Because the conflict is lean behavior says to do everything on the right side, but if you're using the measures, the only way you make the measures look well is to do everything that's in the middle column. So use lean performance measures. And let me just put all these up here. This is the way you counter those non-lean performance measures. And these are 5 categories of operating performance that if you use this combination of measures, performance measures, it supports lean practices and lean tools and methods. So you want to, you know, we want to try to improve productivity. That's a function of eliminating waste, is improving productivity. We want to measure our delivery based on when the customers want it, not some kind of negotiated date. If you have inventory, we want to try to reduce the impact of inventory by measuring, for example, days of inventory or inventory turns. We want to measure defects and rework. That's pretty common in a lot of manufacturing operations. We want to measure cost, but in a lean environment, in a lean accounting environment, we recognize that most of our costs are fixed. In manufacturing, the only true operational variable cost is material. Now, there might be some variability in operating supplies, but your labor is fixed. Your full-time employees, that's a fixed cost. So you want to look at long-term cost reduction, like cost as a percentage of sales. And then lead time, how long does it take us to fill an order? So again, you put these lean performance measurements in place and you use them instead of all of the variance analysis that I just showed you. You don't want to use both because again, you're creating a conflicting message. All right, so let's move this over to Mike.
Thanks, Nick. So we want to look at two specific examples, two cases, and if you're like me, the theory makes sense, but I always want to prove it to myself with the numbers. So let's look at two specific cases that illustrate what happens in the measurement, and also importantly, how it can inform decision making. So here we've got the pre-lean production flow in a particular organization. 4 steps here, and you can see that from a physical layout perspective, they kind of cross each other: large batch size, variation in the amount of time that the product spends in each one of the 4 operations. And from a standard costing perspective, we've got a total labor time of 15 minutes, just adding up the 4 different cells at a labor cost of $5. Based on our hourly rate or our per minute rate. So we've got and we have an overhead cost of 15, material cost of 150. So this costs us $21.50 per unit to produce. What the lean organization is seeking to do, and Nick just went over the measurements, is improve quality, improve throughput, improve lead time, reduce inventory, so that we can make better use of our physical assets and better use of our people resources. So currently, this is the pre-improvement level for the organization. This company takes them 6 weeks from order to delivery of a product to the customer. Inventory is 25 days, and we already talked about the batch size of 2,500, so that's 10 days worth, and only 82% on-time delivery, even with that 6-week lead time. So the first thing, we're going to go through 2 improvement cycles. The first thing this organization is going to do is work on putting these manufacturing processes in line into a cell. So now they run in line, and now we've got, instead of a lot of variability in how much time they're taking in each one of the production centers, we've replaced the CNC machine with a smaller drilling machine. So now we've got more flexibility. We're still doing the same number of units per hour. We still got 10 units per hour, so our output is still the same. But take a look at what we've done. I'm going to start on the right side. Take a look at what the company's done from a lean perspective. Lead time is now down to 2 days. On-time delivery up to 98%. Okay, where our batch size is significantly reduced, and we've dramatically reduced the size of inventory. So think about the working capital on the balance sheet that is no longer being encumbered by inventory and can be redeployed or refocused on other things. Also, with a lot less inventory on site, think about how the physical asset or the plant floor space can be reorganized and redeployed, potentially for other products or greater production capacity. So lots of improvements here from a lean perspective. But what happened on the standard costing side? Our labor time went up to 18 minutes. Okay, so now our labor cost per unit went up to $6. Our overhead cost is up, and our total cost is $25.50. Material cost is still the same. Still costs us the same from a material perspective. And the interesting thing, Nick, you said, is that the material cost is really the only variable cost per unit, but now all of these other numbers have moved. So is this, from the financial perspective using standard costing, this looks like it was a bad thing. Our cost went up from $21.50 to $25.50. Okay, well, a lean organization is still going to proceed forward. There are more improvements we can do in this cell. So let's look at the next round of improvements, which is even more significant. Now we've done from what the lean perspective is called leveling the load. Now, we used to have a production cell that had variability from 1 minute in an operation to 4 minutes to 6 minutes. Now every operation takes 4 minutes. There's no bottleneck in this. Every piece can move through one at a time, and we've now increased our production from 10 units an hour to 15 units an hour. So our lead time, our lean measure is still the same. We still have in that center bottom, you can still see we've still got the same improvements in overall ability to deliver on time to the customer, small lead time, low inventory days. But the benefit from the lean accounting financial perspective is now we've had a dramatic increase in the number of units we can sell. Now, assuming we've got the demand or we can capture the market share in order to generate revenue with those, we've got an additional, now we're using the same machines and the same labor, right? Because our labor cost, and Nick, you brought this up already, is still fixed in the short term. We still have the same people running these same machines in these same 4 production areas. And our labor cost is the same. The only cost that's changed for these additional 5 units an hour is the materials cost, which is only $150. So now we've got an additional $200 in revenue for an additional $1.50 in $7.50 in cost. So that's an additional profit per hour. But now again, from the standard costing perspective, if you look over on the left side, if this were your primary or only lens into understanding the financial impacts of this, labor time is not as high. It was, remember, if it was originally 15, it went up to 18. We still are higher than it was. So our labor cost from a standard costing perspective is still higher. It went up from $5 to $5.33. So our total cost from the standard costing perspective per unit went up from $21.50 to $22.83. So if that's all you were looking at, you would say this was not a financial success. And yet from the lean perspective, it's a dramatic financial success. So that's our, before I go on to the second case, Nick, anything to add to this one?
No, the only thing I've wanted to add is that this example and the next example are true real life examples. The sorry, the names of the companies are changed to protect them, but these we actually encountered these situations.
Mm-hmm.
We're not making the numbers up.
No, and I think that's particular. If we go on to the next case, I think it's particularly significant as we look at the next case, because in this particular one, we're going to talk not just about the lean measures versus the standard costing, but how that informs potentially different decisions, right? This is a make-buy decision. Let's just take a quick look. We've got 2 products running through these 4 manufacturing areas. Each product, there's throughput of 10 units per hour for each product. That's the rate of flow. However, the production time for each product is slightly different. So you can see that product A, 17 minutes, product B, 24. Product B takes more minutes. I think you can probably see where we're going already with this difference in the number of minutes that each product takes. So this is a make-buy decision this company does, and Nick, to your point, this is an actual case. Any product with less than a 30% margin needs to be outsourced, okay? So how are we doing relative to margin for product A and product B? On product A, if we zoom down to the bottom, we've got a margin of almost 39%. Product B has a margin from the standard costing perspective of 25%. And if we think about, again, remember, we're producing 10 an hour. So from the labor perspective, we've got the same hours worth of labor for each unit, each one an average of 6 minutes. And so it's the same labor cost. And then the material cost we can see for products A and B, but now we've got labor and overhead, which is being allocated based on the number of minutes that each unit takes to produce. And we saw that product B takes 24 and product A 17. So since this is the main management lens, the main decision-making lens for this organization, they're going to look at product B and say, we need to outsource it. So I think you can zoom ahead and say, okay, well, what happened? We saved only the material cost for product B for those 10 units an hour. We still have the exact same labor that we're consuming and all of the same overhead that we're consuming. So in reality, and now for product B, we're paying some or other organization its material plus labor on a per unit basis. So we've saved $42 a unit and we're now spending more to purchase product B from another organization. However, we've got to do something to reallocate that labor and overhead from product B. We only have one other product to allocate it to. It's going to go to product A. Now product A's standard margin is going to be less than 30%. So it doesn't meet our organizational make-buy criteria. It's going to get outsourced. Now this whole value stream gets shut down. So you can see the punchline there. Actual costs are not related to the time to produce a product or deliver a service. Any key points, Nick, to add?
Oh, no, this is it. I mean, it's you know, our little term that we use for this is the overhead death spiral.
Yeah.
Meaning, and I've worked in a few companies that, like I worked in one company that they basically were outsourcing production over a course of 10 years, and they wondered why their sales were going up some, but their profits were sort of flat. And so they outsourced they outsourced a lot of production. They got rid of their direct labor, but they didn't get rid of all of the other labor that's made up of overhead. And it was really, really eye-opening to this company to understand that, you know, they were making poor decisions. It was all based on the cost of the product and the thinking.
Now, I
that,
want to just, I'm sorry, Nick, before you go on to the next section, I think
Yeah.
there's an important point here I was just looking back at the poll results. 11% of folks said we don't currently use standard costing. My corporate finance background is in healthcare. And healthcare doesn't use standard costing because there's really no inventory to allocate costs to. However, we still had a fully allocated cost per unit of service that we used for decision making prior to bringing lean thinking into operations and accounting. So we still have the same overhead death spiral in making decisions that you can have with a standard costing system. So I encourage you, those of you who don't currently use standard costing, to look though at how you are reporting your costs and making decisions, because you may fall into the same death spiral. You may fall into have the same pitfall.
Yeah, great. Standard costing is a cost allocation system, and for manufacturing specifically, but like you said, there's lots of industries that use a lot of cost allocation systems.
Yep.
Alrighty. So let's move on. I'm going to talk a little bit about, okay, let's solve these problems, okay? And for purposes of the webinar, there's like, you know, 4 steps, 4 things that you need to, you know, you need to consider, okay, and have a plan. And you know, I want to say here, you know, solving the standard costing problem in a lean company, it's a process, okay? It's not something that just happens overnight. I would say it's highly customized in every company, because you have to really spend some time looking at how do you use standard costing and what is its impact. And you have to be very disciplined. And okay, so what's the what do we need to remove, or how do we need to change things, and do it step by step, okay? You don't have to sort of just dive right in and try to do everything at once. So first, focus on performance measures, all right? Use an integrated lean performance measurement system. Stop using variances and absorption as performance measurements. Now, that doesn't mean that those numbers disappear off the income statement. If you have a standard costing system, you're still going to have the numbers are going to be there. But I guess the easiest way for me to say this is you have to ignore those numbers, okay? And people that read the financial statements, especially internally, they have to learn that what those numbers really mean. Now, they may impact profits, but that doesn't mean they need to try to make judgments on operations based on those numbers. Secondly, profitability analysis. Okay, you know, again, stop using a product cost or margin to understand profitability. Use plain English income statements and actual costs. I'm going to show you all these in detail. Decision making. Again, stop using the standard costing information to make a decision. Okay, it's an estimate. It's not actual. And you know, like we just saw in some examples, is that, you know, the cost information that comes out of standard costing could lead you to a bad decision. use lean accounting box scores. And finally, another purpose of standard costing systems in manufacturing is to value inventory. Now, this is the financial accounting exercise, okay? And you can simplify the data that you're using to create the standards, and therefore eliminate a lot of waste. So let's look at these in a little more detail. We talked about sort of the categories of lean performance measurements, which are listed on the bottom. What's an integrated lean performance measurement system? You think about this like there's three categories of measurements, and we're measuring the same aspects of performance, which are listed at the bottom, but the time frame at which we measure them or the location at which we measure them are a little bit different. So if you look at it from a time frame, monthly lean performance measurements, they're strategic in nature. They're used to assess, the overall, performance of a company or maybe a division in a company. And you're trying to link them to the basic strategic initiatives. Are they working? Are our strategic plans working? And so you look at that, you have like senior leaders or divisional leaders looking at that. On a weekly basis, you're looking more at the operational value streams. How is the value stream in total performing, and is the performance improving over time? Are we getting better at delivery? Are we getting better at productivity? Are we getting better at quality? Because usually, in a lean company, you have performance improvement targets. We want to improve all our performance measures, for example, 10% in a year. All right, so you're looking at that on a weekly cycle. Then when you get down to sort of the production cell level, you're going to be looking at a daily basis, maybe even more frequently, hourly basis. And this is about operational process performance. A daily measure, a daily lean performance measure pretty much answers the question, how did we do today? Did we complete all the orders that we were supposed to complete? And it's yes or no. If it's no, why not? We use lean performance measurements to identify problems and issues, and that drives us to root cause analysis, and then that drives us to what do we have to improve, okay? And because we're looking at measures more not just based on a monthly cycle, like what the monthly variance is, the more frequently, you have daily measures so you can catch problems and issues when they're small and solve them. Weekly issues, again, you have time to adjust as opposed to just having a monthly cycle. Plain English financial statements. So this is just an example of a plain English financial statement in a value stream format for the division of a company. So we have 3 operational value streams: motors, systems, and spare parts, where we're showing the actual sales, the actual costs, so you can see the value stream operating profit. And those numbers, that is what a value stream team is accountable for. You also then separate other costs out, like new product design, that's a function in this division. Your support costs are your basic selling, general, and administrative costs. So you can see, the operating profit for each value stream. You can see the operating profit of about $210,000 for the division. Then that box on the lower left, those are the those are the accounting adjustments that must be done to bring the division profit in compliance with generally accepted accounting principles. So there has to be the valuation of inventory. And in this case, the company has a corporate overhead allocation. So, using a plain English format and a value stream format, you can see the actual operating results, financial operating results, and begin to relate them back to performance measures using what we call the lean accounting box score. We have the performance measurements, we have the value stream income statement, and we also have value stream capacity. Now, you didn't talk much about capacity, but what we do is we want to measure in a very simple way. Okay, we're not talking about a time study, but in general, how much time is spent on value-added productive activities, producing the products that your customers want. How much time is spent on all other activities, whether they're necessary business activities or waste. And then how much capacity is being created over time through improvement. And let me show you that's sort of what the box score looks like. Here's how it's used. So let's say that there are some planned improvements to improve on-time delivery, improve quality, which is first time through, and reduce dock-to-dock days, so improve the days of inventory. So you can calculate what the numbers are going to look like in terms of performance. You can understand what's the actual cost impact just of those improvements. The actual cost impact is material. We have less material cost because we have less inventory and less scrap. What capacity does is it makes visible what the operational impact is. Okay, when you eliminate waste, you create time. We call that capacity in lean accounting. And most improvements, that's what they do. So here we see that the available capacity has been doubled, both for the employees and the machines. From there, you can do a further financial analysis. What are the benefits? Okay, we have all this capacity. How can we use it? And in this example, it's possible that to meet more demand, there is more demand for the products. So you can see that, we have available capacity. What's the financial impact? Well, revenue goes up from 332,000 to almost 428,000. We have a corresponding increase in material cost because it's variable. Our conversion costs, which are the fixed production costs, stay the same. And so our profit goes up from 107,000 to 173,000, or 32% to 40%. And by the way, we get a whole lot more cash. So, this is the benefit of using the box score versus trying to calculate this through standard costing. And simplifying inventory valuation is, again, this is a long-term benefit, and this is more on the accounting and finance side. Standard costing is really a convenient way to value inventory. It's built into the ERP system, and the reporting of the transactions typically just moves all the numbers around in the financial statements. It tells you what your inventory is, tells you what your cost of goods sold are, and so it's good. It works. Okay, and then but again, there's opportunities to eliminate the waste in this. So first of all, you can reduce the number of labor and overhead rates. I worked at a large American aerospace company, and when we were working there, they had 2,000 labor rates and over 500 overhead rates. just in one division. And they actually reduced that. They got both. They ended up with like 20 labor rates and maybe like 50 overhead rates or something like that. But again, just reducing the number of rates, there's less work to do. And it really doesn't impact the cost of products much. If you use work orders, okay, you reduce the number of reporting steps on a work order. The goal would be two. One is we start production, we stop. That's all. Now, obviously, you might have to have a few in between, but every step on a work order requires a transaction or more transactions to be reported. And by the way, even with things like barcoding and scanning, it is possible to make mistakes on work order reporting, and then those mistakes have to be fixed. You have bills of material, you can flatten them and simplify them. If you have production flow, and also transaction reporting. You can stop reporting some actual to work orders. There's no reason to report actual labor to work orders. And then again, you can reduce the number of transactions because, as I said, every transaction that has to be reported in an operation, there is an opportunity for a defect, meaning, if numbers are typed in, they can be typed in wrong. People can forget to report transactions. My point being, lean drives less inventory, and it opens up the opportunity for simplified inventory valuation. Okay, Mike.
So let's take a few minutes just to connect back to how what we've talked about today really helps support the organization's lean strategy, and then we'll make sure we've got time for some questions and discussion. So this is strategic, and again, the lean strategy is about finding ways to improve customer value, the delivery, the quality, and the cost from the customer's perspective, and ensuring that the organization is able to profitably grow and get better financial results. So the mismatch here is that standard costing in organizations is still a mismatch. There's an issue there as you move forward, and we showed examples. You move forward with your lean improvements, you will either lose visibility or have contradictory visibility into financial performance. There is also some issues with what it means to eliminate standard costing. And I think, Nick, you brought this up earlier in a number of different ways, but what we're trying to do is two things at the same time: ensure that we've got more useful internal financial management information that helps support understanding and decision-making, understanding of the lean improvements of the lean strategy and good decision making, while at the same time finding the easiest, simplest ways to stay compliant with GAAP and other external reporting, right? We're not challenging that need at all. We're finding the easiest and simple, but that same information does not help us understand performance internally. So just, yeah, thank you. I was going to say, I think I've covered everything on there. I was just looking at the notes. And so as we think about the lean strategy, we want to make sure that we're understanding operating performance when we're making decisions, right? And we already talked about the incompatibility. This is for any organization that has a cost allocation methodology, this issue of the disconnect between your cost allocation methodology, whether it's step down overhead or standard costing, is inevitable. You're going to discover and need to deal with this. So the sooner you get ahead of it and create joint, global sort of shared understanding, the better. We want to separate, and Nick just went over some specifics on how to do this. Separate if you have to do inventory valuation, yes, but do it simply and separate it from your management accounting system. And as you explore all of these different issues, you're going to find a lot of ways to free up, not just see how you're freeing up capacity in operations in the production environment, but honestly, free up a lot of capacity on the accounting and finance team to focus on analyses, reporting, and other work that is more helpful for the organization. So I do want to cover a couple of quick events. I know we're going to do Q&A, but we've got I'm sorry, go ahead.
No, go for it. I was just gonna start in. I was gonna say, first of all, you guys this is blowing my mind. This is fantastic. I've got so many questions, but I want to give you guys some time. Like this is, there's way more resources that these gentlemen have. So please go ahead.
Yeah, we've got classes coming up. We've got webinars every second Wednesday of the month. We've got a community chat, just an open forum for folks to come and pose questions and have discussion. The third Wednesday of every month, there's signups here. But importantly, we've got a more detailed course to delve into this in your own organization's context starting up next month. So please do go to maskell.com and the events calendar to see more specifics there, and also join the mailing list so you can keep up with events. We've got blogs, workshops, and webinars coming up all the time. So it's a great place to look for more resources.
Yeah, Nick, you have
one more slide, Aaron.
Yeah, go for it. So yeah, the last one here is the resource. Obviously, get the books, guys.
And contact us. We'd love to hear from you.
Yeah, that's the thing. Like we saw over a third of everyone online say, I don't get it. I don't think this is nothing. This is blowing my mind. We've got a few questions, guys, but I'm gonna be selfish. I'm gonna start out with one that I have. So the thing that really kind of it took me a bit, but once you showed that non-productive capacity in the lean accounting side, then it was like, okay. So, and that's a lot of how our manufacturers, our customers in particular, really do find they improve just the overall business performance. So, but especially now with a labor crunch on, my question for both of you is how, with this labor crunch for manufacturing, how does lean accounting help executives understand or even inform the planning for 2022?
Oh, I'll take one crack at this. If you non-productive capacity is an opportunity. If you can make some improvements, you eliminate the non-productive activities, you create capacity, you create more time. And so your existing workforce now has more time to serve customers. And, I experienced this personally as a CFO when I was first introduced to lean thinking in the company I was working in. And I mean, our improvement target was 20% a year, which we hit. And we basically were able to handle any size order, any change in demand, and still get it out in 3 days without building inventory because we had so much capacity. And so, you can struggle. Yes, you have to try to find workers, but you also can try to make improvements.
Yeah. Good. Yeah, that's important. I just think that there's this a very big sea change in I hope part of the 36% that said I don't get it. I'm hoping your phones are going to be ringing because this is really cool. All right, so we do have some questions. I'm trying to figure out which slide this was. So Keith asks if my total labor time increased between slide 1 and slide 3, then how did my total production per hour increase? It seems contradictory. I'm gonna go try and find that, guys.
Yeah, it was. Yeah, exactly. It was back in it was the first of the 2 case examples. It was the total time per unit that increased, but we're actually able to produce, it's this group right here. So if you go back to the first one where we had the mixed up pre-lean production,
okay, here we go.
had a total labor time of 15 minutes per unit here, 1 + 4 + 4 + 6. What the lean organization is trying to do is to reduce batch sizes and smooth out the flow. So I'm able to produce 10 units per hour. And the reason I am is because you can see the grinding operation is the bottleneck. It's 6 minutes. I can't get anything through that's faster than that 6 minutes. So the first improvement is, but I'm still getting the exact same. I mean,
Go to the next slide.
Yeah, go to the next slide. The process is still only performing as good as that bottleneck process. So the first thing I've done is reduce the batch size and improve inventory and level out the operation. Still producing 10 units per hour, but by leveling out the operation, my per unit, which is what's driving my total cost, my per unit minutes is 18. So that's gone up, right? So it's not that I'm producing fewer now, I'm still producing the same.
Yeah.
And then go ahead.
No, I was just going to say, this is lean people who basically, try to redesign operational activities according to lean thinking. They understand that the bottleneck controls the rate of flow.
Mm-hmm.
And they focus on trying to balance all production to the bottleneck and then maybe trying to reduce the bottleneck. And, this is just an example of, total time doesn't matter in terms of output. It's just the bottleneck time. Go ahead. Show the second.
And then in this next slide, what we've done is we've addressed the bottleneck. Now every operation takes 4 minutes. So our total labor time is 4 times 4, it's 16 minutes. It's 1 minute more per unit than what we showed on the first slide. But because the organization has leveled the load through all 4 of these operations, we have now increased the output per hour of total units by 50%. So that's the distinction, right? What the lean management is interested in is what's our rate of throughput by leveling the operation and addressing the bottleneck. From the standard costing perspective, we're assigning the number of minutes per unit in order to assign a labor cost per unit. So that's the distinction. Hopefully that made sense.
Yeah, that's great. Okay, thanks, guys. So another one from Bill. We've got on the plain language financial statement. Does the change in inventory value include the overhead allocation? So I'm going to try and find that slide really quickly.
The answer is yes.
Mm-hmm.
Yeah. The answer is yes. It was right, previous slide.
There we go.
Yeah, the idea is you have all those numbers. You might still have you have absorption, you might have the variances. You sort of just lump all those numbers into just change in inventory because that's what it's related to. And you don't want those numbers to be sort of clog up the operational profit reporting.
Yep. Okay, that makes sense. Appreciate that. Also, Keith did say thank you to you both. He said that makes sense. He wasn't considering the bottleneck that slowed production of total units. And I think that brings up a good point, guys, where, thinking lean like this really makes you think of the fuller system, not just the numbers and the FP&A that goes behind all this. It's actually like, where can you as a financial professional help the operation side? I think that's a great example, breaking down those silos just because of the lean philosophy. So
good point. Yeah.
So we've got just a couple more here. So Jill asked, we are all required to justify all improvement activities showing cost reduction. So how can we change this?
Oh my gosh. Oh my gosh. Oh, I'm sorry, Jill. I'm sorry.
Need an ROI for every improvement event, right?
You want to take this one first, Mike?
Yeah, I'll start. We actually started out that way too, and I was the leading financial planning and analysis at that point, and so we were just completely overwhelmed with all of these ROI calculations for every single improvement event. And I think what it really took was the executive leadership understanding that, and Nick brought this up, is that a lot of what you're doing is creating capacity, and that capacity does not fall to an immediate, in many cases, not going to fall to an immediate financial outcome unless the organization strategically takes advantage of or redeploys that capacity. So we actually, and this is going to maybe sound a little bit silly, we started to move more toward what we called a hard green dollar, soft green dollar analysis. We didn't do it for every single improvement, but we still had to have some expectation that it was, in order to deploy the resources toward leading an improvement or guiding an improvement project, we were looking for either, like I said, the soft green dollars, which was the capacity that was created, that then the organization made visible and then intentionally redeployed in some way through alignment with the strategy, or the hard green dollars, which is just truly the waste or the scrap or the unnecessary overtime that we're reducing. So yeah, I think you have to change the conversation a little bit to why and what are you doing with the information, and how does that connect back to the strategy, and do you understand what it means to create capacity but not redeploy it?
People who have lean experience and plan and conduct improvement events, they have a pretty good idea of what they're going to get out of it. And they may intuitively know that, like, for example, we were reducing the changeover time on a machine. Okay, great. They know that that means more uptime on that machine. And and they can flow faster. And so I'm going to sort of reinforce what Mike said. Can you identify actual cost savings directly due to the improvement event? Okay. And then you have to really, are we creating more capacity? And that's really possibly in the long run avoiding future costs. So it's like, what do you use? Green dollars, and what kind of dollars, Mike?
Yeah, hard green and soft green dollars.
Yeah, hard green and soft green. But you really have to have a conversation. And I truly believe that this is something that accounting and finance can lead.
Yep.
Because you guys know the numbers, and you have an intuitive sense, and you sort of have to have that hard discussion in the company. We can't do this. It drives operational people crazy. I'm going to say that. They pull their hair out because they know that they have to produce this number that's a cost savings, and intuitively they know it's not going to show up.
Right.
So Chris on the line, he agrees with that statement that it drives operations crazy. So thanks, Chris. Appreciate that. So we got one last question, and I'm gonna take the first swipe at it, and then I'm gonna let you gentlemen do it. So what's the best way to get started with lean accounting? Like literally, I think we have some people that are just saying, hey, where do we start? Who needs to be involved? So first thing I'm gonna say is you're gonna involve either Mike or Nick. Just have a discussion. They're open for this 1 hour assessment. So, but then, gentlemen, who else? Like generally, when you start this, who comes to the table? Who do you invite?
Well, it's important to understand. I think that lean accounting should be viewed as an integral part of a company's lean strategy. It's not standalone. It's not something that accounting does on its own. If just think about the information that we talked about today. That information is used by a lot of people in the company. Okay, and accounting produces some of it. They actually use it also. So it's really good to just get a good cross-functional team, finance leaders, company leaders, operational type leaders, and just learn about what lean accounting is, what lean accounting isn't. It's a lot more than standard costing, by the way. I just want to say that. Right. Okay. And learn about what lean accounting is. There's lots of ways to learn. We showed you some of the ways on these slides, and even just contacting us and having a casual conversation about it, asking questions. But you sort of just have to get a good understanding, and then from there, you have to develop your own plans.
Yeah.
Of
Yeah, I
course,
think,
you can always use us to help you do that.
well, you
Mhm.
bring a good point to the table. I mean, listen, if you've got a pretty rigid standard system in place, and you're going to probably see not a lot of people want that change, right? There's a whole piece of change management we don't need to get into, but it starts by learning more, right? Start surfacing the ideas, read the books, right? Here's a great idea, and this is a great plug, and it's shameless, and I don't care. Grab a couple of those books and throw them in your offices if you guys are back in the office, right? So get the ideas flowing, get the learning, bring the learning forward so that the convincing can start, because no one's going to go anywhere unless they start to learn about this.
Another aspect of this is to demonstrate it,
Mhm.
okay, in a very small way, like a pilot, okay, like we talked about the box score. So, you could read books and all that stuff, but what does it mean to us? You know, and this is a lot of the ways we work with companies is, okay, let's put a pilot in. Let's just do one value stream and get a box score in place that is a fully functioning box score that you can use to analyze and make decisions. When people see the numbers, when people see the application of their numbers, not examples that BMA is showing, they go, okay, we get this now.
Yeah, good. All right. Well, Nick and Mike, this is absolutely fantastic. I'm probably going to grab one of those hour-long sessions with you guys because I've got so many more questions just myself. No, but seriously, very, very happy to have you on Beyond Compliance. This is exactly how we move businesses forward and really help to understand a better path for not just profitability, but really delivering to customers. So couple of things coming up, Safety Chain. We've got customer success story with Grupo Navas in Puerto Rico coming up. And then in November, excuse me, we're going to start to talk about OEE, a tune-up. We've got a couple of crash courses going on in overall equipment effectiveness, which is that productivity factor. And I'm now going to be starting to think about this non-productive capacity, and we're going to probably put that in there a little bit. So I appreciate your time, Nick and Mike. Please, we hope to hear from you again, and please have a good day.
Hey, Aaron, one more
Thanks very
thing
much.
before you sign off, if it's okay.
Yeah, please.
For anyone who's listening live or listening to the recording, on the BMA website, www.masco.com, you can register to join the mailing list, and then you'll get all any email we send out about future events and blogs and news and stuff like that. You'll have access to that.
I'm actually going to do that myself. I appreciate that reminder. Good.
Right.
Well, everyone, thank you so much for hanging with us. We did have a ton of you staying. Please, we appreciate your time, and we'll see you next time. Thanks again, Nick and Mike.
Thank you, Aaron.
Thanks a lot.
All right, that'll wrap it up for us, everyone. Have a great day. Cheers.